A liquidity crisis happens when a business, financial institution, or even an entire economy doesn't have enough liquid assets, cash or easily convertible assets, to meet its short-term obligations. It's a financial emergency that can lead to serious consequences like defaults, bankruptcies, or market collapses. Let's break it down with simple terms and an example. Imagine you run a restaurant. You've got $10,000 in your bank account, cash, and $50,000 worth of equipment like ovens and tables. Your rent is due tomorrow at $12,000, but you only have $10,000 in cash. Even though your business is worth more than $50,000 overall, you're in a liquidity crisis because you don't have enough liquid cash to pay your immediate bills. This is different from insolvency, where a business's total assets are worth less than its liabilities. In a liquidity crisis, you might have plenty of assets, but they aren't easily converted to cash in time to cover urgent needs. Liquidity crises can happen to individuals, businesses, or even entire financial systems. In businesses, it might occur if sales slow down, customers delay payments, or loans are suddenly called in by banks. On a larger scale, a financial institution might face a liquidity crisis if too many customers withdraw money at the same time, like during a bank run. Here's a broader example. During the 2008 financial crisis, banks held large amounts of mortgage-backed securities, which became nearly impossible to sell when the housing market collapsed. Even though these securities were valuable on paper, the banks couldn't convert them to cash quickly enough to meet withdrawals and obligations. This liquidity crisis caused widespread panic and required government intervention to stabilize the system. What causes a liquidity crisis? It often stems from poor planning, market shocks, or a loss of confidence. For instance, if investors lose trust in a company or bank, they might pull their money out quickly, triggering a liquidity crunch. External events, like a pandemic or economic downturn, can also dry up cash flow and make it harder to borrow or sell assets. Why is liquidity important? Having enough liquid assets ensures that businesses and economies can function smoothly. For example, if your restaurant had kept more cash on hand or set up a line of credit, you could have avoided the crisis and paid the rent on time. To prevent or manage a liquidity crisis, businesses and institutions use strategies like maintaining cash reserves, diversifying income streams, or securing access to emergency loans. Governments and central banks also step in during major liquidity crises by injecting cash into the system or lowering interest rates to encourage borrowing and spending. In summary, a liquidity crisis occurs when there isn't enough cash to meet immediate obligations, even if there are valuable assets on hand. It can lead to serious consequences if not addressed quickly. Planning ahead and managing cash flow effectively are key to avoiding liquidity problems.